Hi class, this video is going to focus on how we evaluate financial performance, but is really going to hone in on one key part of the analysis, which is analysing profitability. If you're using the Macmillan textbook, this is chapter 22, which involves pages 391 to 409. Not all of that is about profitability, it also covers liquidity. So what is profitability and why is it so important to evaluating financial performance? Profitability, as we know, particularly if we've watched previous videos, is the ability of a business to make a profit compared against a base such as sales, assets, or owner's equity. What is profit? Profit is our revenue earned minus our expenses incurred. So what are the strategies to improve it? To improve a number of profit, we must either increase our revenue or decrease our expenses. So if we're thinking of strategies to improve revenue, we might be making decisions that involve the selling price. So let's highlight these as we go so we're following on. We might be looking at the selling price. Should we decrease it to make more sales or increase it to get more revenue per sale? And if we're looking to earn more sales, maybe we should be thinking about advertising, our stock mix. So should we maybe remove stock that isn't selling to have more space for the stock that is selling well? And when I say stock, I should be saying inventory. And should we be considering our non-current assets? Should we be maybe increasing our non-current assets, buying some more to earn more revenue? Or should we replace our old non-current assets with more efficient non-current assets? Lots of things to be thinking about, and we should always be considering what is the customer experience, because customers are the people that buy our goods. If we're looking to reduce our expenses, we might be thinking about our management of inventory. So should we be looking at ways to obtain cheaper or stock inventory, or maybe find higher quality inventory? How are we managing our staff? Should we be improving our rostering or reducing our staff costs, or look at other ways to improve their productivity? And should we be managing our non-current assets? Should we be getting rid of inefficient assets that are costing us expenses, electricity, and let's not forget depreciation? So these are the things that we'll consider, but we need some tools or indicators that allow us to determine how profitable our business is. And our profitability indicators are 5 important indicators that we know we must know. The 5 that we must know that to analyze profit is gross profit margin, net profit margin, return on assets, asset turnover, and return on owner's investment. These are the 5 that we must know to analyze profitability, and typical exam questions will involve all of these at once. It's very unlikely that you'll see a question in an exam that involves just one of them. You're going to have to look at all of them and think how they interact. So how do we do something that's quite difficult like that? We need to be using our financial indicators effectively. And there are a number of things that we need to know for each of these financial indicators, which is really the purpose of this video. Do you know the formula? Do you know the formula of each indicator? You're never going to be asked in an exam question to calculate one, but you do need to know the inputs, because it is these inputs that drive the numbers. So you need to know if this input goes up or down, is that going to create a good or bad indicator? Secondly, you're going to need to know, what does the indicator analyze? Or maybe simply, what does it tell us? We know that these are profitability indicators that we're going to look at today, but what do they actually tell us? They all tell us something slightly different. We then need to know, is the movement in this indicator favourable or unfavourable? And this is terminology we want to see in your responses. Not everything going up is favourable, not everything going down is unfavourable, although in this case, profitability, it really is. But is the movement favourable, a good thing, or unfavourable? Because we're going to be using typically horizontal analysis on this, or analysing against a benchmark. And then for some of these, what might be considered a good or bad value. Some of these indicators actually have a value that you would expect to see. It's not always easy because businesses are different, but what would we be looking for? And then if we know all this, we can then start to think about advice. What might have caused the changes in the indicator? Particularly if we have a number of indicators, how have they worked together to tell us a story of our business? And then importantly, once we've been that detective and worked all this out, what advice can you give regarding strategies to improve that indicator? Because all of this analysis is just about allowing us to make better decisions. So we're going to go through each of those concepts, each of these things we need to tick off for the 5 indicators to do with profitability. And the first one we come to is return on owner's investment. The formula for this indicator is net profit divided by average capital times 100. And we don't need to know too much about that. We never have to calculate it, but we do know the 2 inputs are net profit and average capital. So anything that impacts those is going to impact our return on investment. What does this indicator analyze? It is telling us the profitability from an investor's point of view. It determines the profit made by the business as a percentage of the owner's capital. So examples are always good. A return on investment of 25% means a return of $0.25 or 25 cents of net profit for each $1 invested. If the business owner invests $1, they are going to get a return of 25% or 25 cents. And that sounds pretty good. We need to know how it is measured and whether we want it to go up or down. Return on investment is a percentage. So we're going to see it, for example, 25%. And we want this to go up because increases are favorable. How do we get this to go up? By either getting our net profit to go up or our average capital to go down. So how do we analyze it? What might be considered a good or bad value? This is hard. But when evaluating an owner's return on investment, the usual benchmarks include comparisons with alternative investments. What would the business owner expect to be able to get as a return from another investment? Or what would it be compared to what was budgeted, what was expected, or maybe what was a previous period's rate of return? Something that's unique potentially for return on owner's investment is we should also consider the riskiness of the investment. This is when we look at debt ratio, and we'll look at a question in this one, but we have a businesses owners expect a certain return for their risk. As the business gets riskier, they expect a higher return. And how do we analyze riskiness? We look at lots of things, but one of the major ones we look at is debt ratio, because this is about stability. More debt, more risk. So how can we improve this indicator? We can increase it, which remembering is favorable, by increasing our profits, decreasing owner's equity, or getting a higher gearing, which means we're going to be more reliant on debt than equity. So our debt will go up, owner's equity will go down, which ultimately increases our return on investment. It is decreased, this is unfavorable. If we have an increased owner's equity, that leads to a stable or decreased profits, or we have lower gearing. So now is probably a good time after each of these to stop, because that's a lot of information, build your summary notes, make sure you really understand return on owner's investment. And we can start to think about this if we analyze a simple statement. Return on investment fell from 33% in 2022 to 29% in 2023. How would you analyze this without knowing anything else? How would you describe it? And what would you maybe guess would be some of the reasons why it's decreased? If you can do that, then you're ready to move on. Our next indicator is return on assets. The formula here is again net profit. This isn't surprising. all of these have something to do with profitability, divided by average total assets. What does this one analyze? It shows how productive or profitable the business assets have been in terms of earning profit. So if a return on assets of 12% means the assets returned 12 cents of net profit for every $1 of assets in their business. This is measuring the effectiveness and the efficiency of our assets to make profit. The return on asset involves two important indicators: net profit margin and asset turnover. Return on assets, this one should say assets, is measured as a percentage again. We've been told it's 12% here. And we clearly want this to go up, so increases are favourable. How do we analyse it? We're going to look at trends, budgets, and industry averages is an important one here. Why? Because it's really hard to analyse across different industries here, because different industries have a different amount of assets that they need to make profit. So how do we improve it? What might be the reason for a trend? If it is increased, this is favourable, and this is going to be likely due to more effective use of our assets. We're getting more profit for every dollar of assets. This might mean that we have disposed of unused or unproductive assets. If we get rid of assets not making profit, our average total assets goes down and our net profit isn't changed that much. And we could also improve our expenses, because improved expenses improves our profit. We could also lease assets rather than purchase them, because if we lease them, they typically won't be on our balance sheet as a total asset, but we still get to control them. That's a complicated one. It is decreased, which is unfavourable, if we are less effective at using our assets. We get less profit for every dollar of assets. We have poor expense control, or we replace our assets at higher prices, which will increase our total assets, and it might not result in net profit immediately. So this could be a good thing, but in the short term, it reduces our return on assets. So again, do you understand this? Have you got your summary notes really detailed? And if so, can you analyze this one? Return on assets has increased from 14% in 2023 from 12% in 2022. What does this mean? How do we interpret it? What might be some of the reasons for it? And now we move to a complicated one called asset turnover. Complicated because we measure it slightly differently. Asset turnover has a formula that is this. It is net sales, and that's a key thing to note. We're not looking at profit now, we're looking at sales. Sales are important to profit, but we know they're only one half of the equation, divided by average total assets. What does the indicator analyze? It compares sales revenue with the average investment in the business total assets. So in doing so, it's not telling us how well it makes profit, it tells us how well the assets are being used to generate sales. How good are our assets at creating sales? So an asset turnover of 2 times per period, and what do you notice? This isn't a percentage, it is a times per period, and this is how it's going to be reported, mean that its assets generated twice as many sales as their value. So they generated 2 times sales of their value. So asset turnover is measured as times per period. We want this number to increase. Increases are favourable. But we don't say increase, we say it is faster or slower. So an increase is going to be saying it is faster. So how do we analyse it? For every dollar invested in assets, we're essentially saying X cents of sales revenue are generated. So if the asset turnover decreases, this is a bad thing, and this would mean that assets aren't generating the same amount of sales or revenue. So this could be replicating the turnover rate and then we have some things to try and work out. We again look at trends, budgets, and industry averages to try and work out why this has happened. What is the reason for this trend? This will increase potentially, which is favourable, if we are more effectively using our assets, if we are disposing of our unused or unproductive assets, or we have increased sales. So similar reasons than return on assets, but the key difference is increased sales is what's going to increase this, not increase profit. This will decrease if we manage our assets poorly, particularly our inventory and accounts receivable. If we have too much inventory and too much accounts receivable, we might have a higher average total assets. And you might be saying, why is it a bad thing to have too much accounts receivable? Remember, bad debts. We want our customers to pay us back really quickly. And inventory, we know, is a vulnerable asset. We don't want it to cost money to store, and we don't want it to be damaged or anything like that. And it could also be decreasing if we're just not being efficiently managing our assets and we're retaining inefficient assets. So again, can you analyze asset turnover? Could you come up with a situation where asset turnover goes from 1.8 times to 2.5 times per period? How would you explain it? And then we come to the final two, which we'll go through a bit quicker because they're probably a bit simpler. Gross profit margin is one that hopefully you've heard of before. Gross profit margin has a formula that is gross profit. So we're now looking at not net profit, we're looking at a specific profit, the first profit we report in our income statement. And we divide it by net sales. What does this indicator analyze? It is the percentage of the sales dollar. So we're back to a percentage earned as gross profit. What is the percentage of the sale that equals gross profit? And this is crucial as it tells us the relationship in a business between its cost price, what it buys its inventory for, and the selling price, what it sells it for. And this is crucial for profitability. It's an important decision in a business. If the cost prices increase, but the business can't keep increasing its selling price, so the selling price remains constant, the gross profit margin will fall. But if the business has the ability to increase the markup as the costs increase, the gross profit margin will increase, which is what we want it to do. Because a gross profit margin is measured as a percentage and increases are favourable. How do we analyse it? We look at trends, budgets, and industry averages, and we want it to go up. But how do we get it to go up? Perhaps the most important one to remember is increasing your sales does not increase gross profit margin. Only increasing your markup. If you just sell more at the same gross profit margin, your gross profit margin doesn't improve. But improving your markup will. Decreasing a cost price will. And it will be decreased by decreased markup or a decrease in selling price or an increase in cost price. So can you analyse one that said gross profit margin increased from 47.3% in 2022 and has increased to 51.7%? How would you analyse this? What would you consider? What would you look at to try and work out why this has occurred? And then we come to the final one. Well done to getting to the end. I hope you've got great notes. Net profit margin. Net profit margin is similar to gross profit, but it doesn't look at net gross profit. It looks at net profit divided by sales. So it's not going to tell us the relationship between cost price and selling price. That is an important aspect. It's really showing the percentage of sales dollars that result in net profit. How much net profit, our answer in our income statement, is earned per sale. So what it's really doing is not analysing the relationship between cost price and selling price. It's looking at everything. It's assessing your expense control, as it is this expense control that is crucial to net profitability. We again measure it as a percentage, and increases are favourable. We're looking at benchmarks, and we do understand, like almost all of these indicators, it's really hard to analyse it compared to other businesses unless they're in the same industry, because each business is unique in terms of its revenues and expenses. Some have similar expenses, some don't. It's really hard to sometimes analyse across different ones. But what we can look at is trends. Is our net profit margin going up or down? How is it comparing to our budget? How is it comparing to other competitors potentially? We want it to increase, and the only way it can increase, which is favourable, is by some things such as an improved gross profit margin, improved expenses, or increasing sales. This one is different because it is net profit. Increased sales will hopefully improve net profit, especially if this is associated with looking after our expenses. It will decrease by the other things as well. Decreased profit margin, poor expense control, or reduced sales. And could you then analyse one where a net profit margin has decreased from 11.3% to 9.7%? If you can do all this, if you have understood it and been able to tick off all the aspects of these indicators, now you are probably ready to answer some questions. And the best way to get ready to understand this topic is to not go to the textbook, but to run straight to past exam questions and think about how these indicators link. And this is where the skill comes in, to be the detective, to not just restate what has been given to you, but analyze it, tell me what's happened, how have they linked, what is good, what is bad, and what might be some strategies or reasons why this has occurred. And now's the time to really practice and become an expert at evaluating financial performance in the realms of profitability. Well done for watching a really long video that I hope has helped you in this task.